Let's talk a little bit of tech because Adam Seessel is the founder of Gravity Capital Management, advises on assets of roughly $8 billion, also author of Where the Money Is, Value Investing in the Digital Age. And here we are. Where is the money? Well, where's the money supposed to be in this digital age and in what has to be considered a winter of sorts, not just for crypto, but for the digital universe, Adam?
Yeah, well, good morning, Andrew. Look, the money is where it's always been, in the sense that it's always been in superior businesses. Peter Lynch said a generation ago that in the end, superior businesses win, and those victories will be reflected in the marketplace. It's just that in the early 21st century, most of those moated businesses, to use Buffett's phrases, are in tech.
So who's got the moat?
Well, I mean, a couple that we really like right now are Amazon, which I was surprised to hear Cliff Asness likes. That's down, 40% year to date, and no one's going to catch it in e-commerce. It has about a 50% market share of e-commerce. Walmart tanked their margins a few years ago to try to get into e-commerce. They have 7% market share.
When you look at the upside, but before you go on, when you look at the upside and downside, and I know market timing is not a great business to be in, and you say to yourself, here's a stock that's down 40%. Do you say to yourself, there's a stock that could go down another 10, 20%? Do you say to yourself, there's a stock that can go up 30%? And what's the time horizon on both ends of that look like to you?
Yeah, well, it's very hard to pick the bottom. And as you know, value investors are used to going into stocks that are falling, and always stocks overshoot what we think is their cheapest value. So you've got to be realistic. On the other hand, when you think that Amazon can grow in e-commerce and in cloud 15, 20% a year for 15 or 20 years, the internal rate of return over 3, 5, 10 years is pretty enormous. I mean, they've had a little setback with post-pandemic, but I think everyone agrees that they're an inevitable stock for the next 10, 15 years.
What else is on your list?
Well, we love Alphabet. I mean, Alphabet is sort of so simple that people forget about it. And it has 95% share of market search, online search. It's, Amazon tried to build search, couldn't. Bing tried to do it. Microsoft spent $15 billion, couldn't do it. We've got optionality in YouTube and cloud and Android and even Waymo. And it's trading for 19 times 2021 earnings. So even in a recession, it's trading for a low 20s multiple, and a 5% free cash flow entry yield is a wonderful place to start for a value investor for a company.
We've been talking all morning about living in the metaverse, given the interview that Mark Zuckerberg gave to Jim Cramer last night. Do you like Meta?
I saw it. No, I don't like Meta. I've never liked Meta. And it sort of illustrates what I talk about in the book, which is, tech is where the money is long term. But most tech companies are going to suffer the same fate that all companies in any industry are going to suffer, which is mediocrity, because capitalism is so competitive that unless you have a moat, unless you have an edge, your business advantage is going to be competed away. And so you see that with Meta. You saw that, Zuckerberg bought two of his rivals, Instagram and WhatsApp. Right. And then when he couldn't buy TikTok, that's when the pivot happened. So Meta, in my book, and it's a fine company, and Jim Cramer might be right on the metaverse, but when you change your name and pivot, it's not usually a good sign.